This corporate governance will be around 8 marks. Okay, around 8 marks. They will test you in MCQs, section A as well as in section B. It has been very clearly. Can I start now?
Yeah.
It's very clearly. What
Yes.
it's. Yes, tell me please.
No, I wanted to say start, my brother.
Huh?
You can start, sir.
Yeah. When you are doing this, is it? We have the codes of, see, what is first, you should understand what is the corporate governance. Corporate governance is one of the important aspects of audit. The way the company will govern, control, how the company is managed, is that how the company is managed, how the company is governed is one of the important aspects of corporate governance. Nowadays, every financial report will have at the end they will have a corporate governance report. Okay, we will have a corporate governance. We will cover this code of corporate governance, the role of audit committee. Okay, how the audit committee will be there. We will also take into consideration internal control effectiveness. It is little bit early to talk about internal controls, but it makes sense. Okay, it makes sense that how we are effectiveness. Controls are there, but controls are effective or not effective. And last but not the least, this is what it says, how you have to communicate with the people who are those charged with governance. They will use those charged with governance, TCWG. Okay, in short, we will not use this, but somewhere in other material they have used like this. Okay, these are the things. Now, corporate governance is nothing but how basically how the board of directors, is it, how the board of directors, formation of board. Okay, formation of the board. The rule says that the board of directors, there are two different segments are there. The first one is a executive directors, and these are the people who are full time, and the second is non-executive. Isn't it? Non-executive. Non-executive are otherwise called as independent directors. Okay, independent. The rule says that there should be balance. Either you will have the chairman will be there. Okay, you will have in the middle you will have the chairman will be there. But if you are having 10, 11 people, okay, one will be the chairman, 5 should be executive directors, and 5 should be non-executive directors. If you are,
Actually, the chairman
huh?
is independent. The chairman is independent.
Chairman is, yeah, it's not independent. Chairman will vote. Okay, chairman. But what is say apart from chairman, just exclude the chairman. 5 will be from the chairman will be from the full time only. Okay, chairman will be part of that only. 5 will be executive and 5 will be, assume, I am not including chairman. Assume you have 6 directors. Then in that case, 3 will be from independent, 3 will be from executive. This question will be asked in the examination. Scenario based question, section A. Okay, section A, scenario based. Now, the rule says that when you are talking about the independent directors, one of the independent directors should have a financial qualification, professional qualification, certification. Okay, he should have a professional qualification, any professional, ACCA, whatever you can take it, but from the perspective of that, we should have a one person independent director. Is that these are the this we call it as a composition. Composition of board of directors. Okay, composition of board of directors. We cover this. Very simple, very easy, understandable. Common sense we should have, as simple as that. Everything will come. Or in the Israel, everything will come. Now what we are doing? What are the things? Discuss the objectives, is it relevance and importance of corporate governance. Is that the first thing we are doing? What are the provisions of international code of corporate governance? Okay, what are the things we should take into consideration when we are talking about the corporate governance? And most importantly, what we have to take into consideration with respect to OECD. What is the OECD? Any idea?
No.
Organization, is it right? Organization for economic cooperation and development. Okay, OECD. Discuss the provisions of International Code of Corporate Governance such as OECD that are most relevant, which are relevant to auditors. We are not covering all. We are taking only the things which are related to all. Describe corporate governance requirements in terms of related to what where we are working out. We are working only with respect to directors' responsibilities and more importantly risk management and internal control. Because when we say directors, these are the people who are charged with governance. These are the people who are charged with governance. Okay, though very simple. Corporate governance, you should know what are the responsibilities of the director. When we say responsibilities of the directors, we will get both. Is it right? Both executive and independent. I will not use non-executive. You can use both executive and independent. Independent directors is more understandable. Okay, from my perspective, we can use in most of the cases they will say non-executive directors, NED. Is that NED? What is the good corporate governance we should follow? Okay, what are the rules and regulations of good corporate? Analyze now. What happens? See the things. If you take into consideration what will happen, assume this is the structure, board of directors. Is that board of directors? Board of directors will be there, then after that CEO will be there. Okay, in between what will happen, there will be a audit committee will be there. Audit committee is exclusively consist of whom? Independent directors, non-executive directors. Understand? See, if you understand this, listen this, you don't need revision for this chapter. Take my word. Take my word. That much clarity I will give you the message. Okay? That much clarity. Slowly and steadily. We want to know what is the structure and the role. Audit committee plays a very important role in terms of appointments. Okay, in terms of appointments, it oversees the functioning of the entire organization exclusively with respect to top level managers. And definitely if we are talking about the audit committee plays very crucial, very significant, very critical role with respect to benefits and limitations. See, these are the things where they target the questions. They target the questions based on the audit committee. They target the questions based on the audit committee. We will cover in detail. Now, what happens? You will have the controls. Is it right? We will have the controls. We will test the control, test of control. This comes at a very later stage. Now, if you are, this is the major, this is the part of whom, this is the responsibility of the internal auditor. We are not covering that at this point of time, what internal auditor or not. We are saying that if the controls are there, internal auditor on behalf of the management implement controls. Is that internal auditor on behalf of the internal auditor is an employee of the organization. He will implement, he will identify, he will implement, he will evaluate, he will make modification changes, he will do that. Now, but what happens? It is not the internal auditor who is responsible. The people who are responsible is what? The people who are responsible is the charge with governance. The internal controls is the importance, whether internal controls are effective, internal controls make things easy. See what we are doing, the only objective is you have to reduce the fraud. Is that you have to reduce the fraud and error. That is the principal objective. Is it? There is the principle of it. You have to reduce how best you should have it. See, on paper you will have internal controls, but internal controls are not effective. Internal controls will not give any meaning. Again, I am saying from here, from this chapter it is not there, but on the subsequent chapters they will have on internal controls. Is it? Subsequent chapter. Discuss the need of auditors. Discuss the need of auditors to communicate with charge. See, anything is there. What the auditors will do, auditors will try to get the things as much as possible with the related access. Once they are not getting sufficient and appropriate evidence, then they will go to the higher ups. See the thing, this is where they will test you. Students will write immediately that yes, we are going to have charge with governance. Directly we are. No, that communication comes at a very later stage. You will explore all the options, as much options as possible. The last thing is we are going to approach the charge with the governance or the directors. Then we will get the written representation from the directors. Okay, that is what it says. How we have to make communication. What is the procedure? We should not initially we should not seek the response from the top level managers. Is that now? When we say corporate governance, see the thing. You will say it is the principles. We are talking about UK Corporate Governance Code. Is it right? We will see this as point number 1. We will take this at point number 2. What the audit committee will do? Audit committee will oversee. Audit committee will see that whatever the internal auditor is doing with respect to internal controls, audit committee will see its effectiveness, whether the internal controls are effective or not. And audit committee will work as a channel of communication between the board of directors. The audit committee, because they will communicate. Anything is there, anything which is going to be. See, we should not be, when we are learning this, we should not be from any negative. People say auditors are negative. No, auditors are never negative. Auditors, the role of the auditors is to make things improve. That's the very basic principle. If you understand this, 90% of our job is done. You should know, yes, they are taking the suggestions and we should identify where there are the shortcomings and where there should be improvements. Anything is there, The audit, see, why audit committee is communicating with charge with government? Audit committee is the level of highest level of committee. Is that the highest level? They will have the access to the board of directors. Okay, we will cover this. They will ask in our question. They will in this lecture. Where the questions will be focused. The questions will be focused primarily on the corporate governance, and apart from that, the questions will also be focused on the audit committee. These are the two key areas where we have to understand and where we have to work. Now, what is the corporate governance in action? Is it right? What they do? What is the importance? Is it right? Board leadership and company purpose. Is it sure? Corporate governance is a board of directors. Is it right? You have the board. Any doubt, anywhere, you stop me. Understand why? Any doubt, anywhere. It's not a one-way process. Board leadership and company purpose. See, leadership plays a very critical role. How the instructions come from the top, the people will implement that. They are the role models. Okay, they are the role models. When we are talking about the board, it is the topmost. It is the topmost decision-making body. Okay, when we are saying it's a topmost decision-making body, it takes the decisions from strategic point of view, long-term point of view. Is that from the long? See, we are sending a message to our stakeholders practically. Is that we are sending a message to our stakeholders practically that how we are managing. See, that's what they say. The top management, if top level management is effective, automatically the things will roll down to the lowest level of managers. Effective board leadership. Decisions, see, decisions should be strategic, decisions should be effective, and decisions should be productive also. Is it? Decisions should be productive. That's what, when we are saying productive, we should say decisions should be efficient and decisions should be effective. Effective board leadership. Okay, promote long term. We are not here for the short term. As a matter of fact, no company will be there for the short term. Every company, see, you are doing the business. You are not here for 1 or 2 years. You want to be there in the business for. You see all the companies. You see all the companies. You see the most of the banks. Is that most of the companies, multinational corporations, they are doing. They want to sustain. They want to survive. Okay, we want to sustain, we want to exist. Is that, and we long term, and we need to have a success. There should be a growth. As simple as possible, that's what we are talking about. We will say that directors should lead by example. Very simple, very reasonable, very easy to score marks. Now, that is the one. What are the divisions? See, you should have. See, we are always talk about this. This is the. You have a segregation of duties. You take this word everywhere it will come. You talk about internal controls also, segregation of duties. Where they say though two persons should be there. In most of the cases, they will ask you this, they will test you. The moment you are doing the examination questions, you will come across these points. They said that chairman and chairman and CEO are same. No, chairman is with respect to board of directors, CEO is with respect to what is the role of the CEO? CEO will see operational activities. The board of directors will see strategic. You cannot, one person is thinking about long term and the same person is thinking about the short term. Definitely corporate governance structure is weak. Is that corporate governance structure is weak? That is the reason what they say division of. you should have an independent chairman who leads the board. Even the chairman has to be independent. But we'll find rare cases, okay? We'll find rare cases. But we'll try to. CEO and chair should be two different individuals. Okay, CEO and chair should be. See, if you refer this slide, is that almost you are thorough with this chapter. Okay, broadly, is that you should make sure that CEO and chairman should be two different individuals. Board should be balanced. That I said. If you are having six, you cannot say in the question, in the scenario, they will say. You will say that 4 people are executive directors and 2 people are non-executive directors. Is it justifiable? Then they will ask, what are the assumptions? Is that what are the assumptions? Then you should come to a conclusion that yes, this is not. Chair, the non-executive directors doesn't have person with financial qualification. See, finance qualification, you have to give independent advice. That is what it says. Is that the purpose of having a independent director means you should keep a close watch what's happening. Because see, when whichever activity, take example, if a firm is approaching a bank for a loan, huge amount, is not a small amount, huge amount, runs in millions. Okay, one of the thing bank will see is who are the people who are the board of directors. They will see financial statements. They will see, but definitely we are giving such a big amount of loan, but this loan, to whom we are giving, in whose hands we are giving this loan, who is going to take decisions on this amount, that is very important. That is very important. That is the reason we are talking in terms of what? It should be balanced. It should be independent. Is that if it is imbalanced, see, we are not coming to a conclusion that people who are having no balance, it will not be effective. We are not saying that. We prefer, we advise, we suggest that the board should be this. They are not using the word must. If they say must, it should be equal. They say it is should. Is that you should be very careful about these two things. If it is must, means no option. If it is should, means you are giving a suggestion. Is it? These are the things that matters. In some cases, we use must. In some cases, we use should. What they are saying? They are saying that board should be balanced. Half of the board should be independent. Again, they are saying should. Is that they say that half of the board? See, sometimes in some years, in some 6 months, somebody has been retired, somebody has been resigned, somebody is not having a replacement. That's fine, but consistently it should not be imbalanced. Is it? These are the points 1, 2, 3, 4. These are the things they will test you in MCQ. This is the division of responsibility. You should have a CEO and the chairman should be different, board should be balanced, half of the board should be independent, and independent chair leads the board. Independent person preferably is a non-executive director should be the chairman of the company. Now, how is composition, succession and evaluation? How we are going to appoint people? How you are going to appoint the directors? Is it right? That they say that board appoints made by nomination committee. Nomination committee. Nomination board appointments will by majority of the people will be whom? Independent non-executive directors. Is it right? Independent non-executive executive directors. Now you can understand how important are these people are there. Okay, appointment based on merit. There's nothing like you will have okay XYZ fine. No, it should be appointment. Should be means you should have qualifications. You should have experience. You should have see when you are saying best person, you should have qualification. Okay, you should have qualification. You should have experience, and more important, you should have expertise. Is it right? You should be expertise. Means you should be professional in your area. If you are talking about an airline industry, in airline industry we cannot appoint somebody from oil industry. Is that airline industry? There should be people who are expert in airline industry. If they've been appointed, definitely what will happen? The company will grow. The decisions will be effective. Is that the company will grow and the decisions will be effective. That is the reason you should have qualification, you should have experience, and you should have expertise. Combination of skills and experience means every other person cannot become director. See, directors gives the message to the stakeholders that yes, the company is in the safest hands. The company is having a very good strategic future, and directors, there should be election and re-election. Is it? They should see. They say it all depends. Now, what is a so in some companies they will have elections every 2 years. In some companies they will have elections. They have free. We are not talking about the how many years, but the rule says that it should be re-elected. Elections should be there. Is that elections by the? It makes sense. Is it right? It makes sense. And most importantly, chair must be replaced after how many years? 9. This is a suggestions. Understand what? These are the suggestions. The suggestions, again, we go in detail why these suggestions are there and how it will have impact on the functioning of the firm as such. Are you clear about this? This is point number 1. This is point number 2 and point number 3. Is it right? This is 1.1, 1.2, 1.3. This is 2.1, 2.2, 2.3 and 2.4. This is 3.1, 3.2, 3.3 and 3.4. Are you clear about this?
Yes.
Fine. Is it clear? Simple things are there. Is it? Simple things are. Is where there is a difficulty, I will tell you the thing. Corporate governance system, where the only thing is what this is the general definition of the corporate governance, how it has been directed and controlled. Maybe you have covered this in most of in the previous cases, situations also. Yeah, how we are directing and why company needs governance? Is it because it ensures all stakeholders with a relevant interest in the company business are fully taken into account. See, when you are talking about the thing, we are saying that there should be executive directors and independent non-executive directors. See, you are investing in the business. You are purchasing the shares. Is it right? You are investing your hard-earned money. When you invest your hard-earned money, you will think 100 times. It is like you are purchasing a product. Either you are purchasing, if you want to purchase a smartphone also, you will think. It's not like straight away you will go. You will think which one is better, which one is feasible. Now you are investing, and you are investing with the intention what? You are investing with the intention that the wealth should increase. And you don't know the people who are on the other side. Understand why? You don't know the people on the other side. Now you will see that how whether the interest relevant interest in the company business are taken. Means you should see that really these people are doing business in the way business is done. Is that you will not see, you will not hire, as simple as that, you will not hire some less educated person. Okay, you will not hire. You are paying, you are investing. Then you, when you are investing, you see that those people have the capability to make good decisions, and because of good decisions, the wealth will increase or not. The bottom line is one thing. The bottom line is we are thinking, everyone thinks about only one thing, wealth only. Is it? We only think about one specific thing. There is no plus, there is no minus. Okay? There is no plus. Now, Organization for Economic Cooperation and Development. It's an international organization. Is it right? It is an international. What it does, it talks about equality, it talks about prosperity, it talks about opportunity, it talks about well-being. Is that what it says? It talks about so many things. Organization of Economic Cooperation and Development. They say that it says that there should be prosperity, there should be growth. Okay? It says that there should be an equality. See, now what happens, you will see how it is governed. See, you will have, in the firm, you will have shareholders. Is it right? You have the shareholders. Shareholders will have different weightages. Somebody will have more, somebody will have less. We are not concerned about the shareholders who are majority in stake, who are having more shares. Why corporate governance comes into picture is we are talking about those shareholders who are the retail shareholders, small shareholders. See, you are investing, assume you are investing $10,000 in one of the multinational corporations. You are investing in Tesla, $10,000. Is that? Our amount is, if you take into consideration, it is even less than 0.00001%. We are nowhere. We are like a salt in the food, as simple as that. Understand my point? We are just a salt, pinch of salt. That is there. We are not having. Now, for them it will be a small money, but for you it is a huge money. For you it is a huge money. That is the reason we are talking in terms of, we are talking about prosperity, we are talking about equality. Is it right? We are talking about equality. We are talking about, most important, we are talking about the well-being of all. All shareholders and most importantly stakeholders also. The OECD principles of EASE serve as a reference. It gives a reference framework for countries and companies to develop their own code of governance, such as the UK Corporate Governance Code. Now it is principally, if you take into consideration, it is by default, we have to submit corporate governance report. Now, I will ask you, why corporate governance is important? If you are, the corporate governance is important because it wants to protect basically whom? The retail shareholders. Is that? This is where it gives. That's why corporate governance is important, because it ensure all stakeholders with relevant interest. Everybody, whether, now if you ask me, we have not done this, but if you go further, we have covered stakeholders like employees, government, lenders, shareholders. But one of the important shareholders will miss all the time. We will miss that public is also one of the important stakeholder. Is that public is also one of the important shareholders. It's not that we are just focusing on one area and we are ignoring the other area as such. Are you clear about this?
Yes.
No. What it says, it should see now it's for you it is a very easy task. Okay, what is that? It should promote very transparent and efficient markets. Why it should be transparent? That's all. When we are saying that we are having a balanced board of directors, it makes that it should be transparent. Okay. Now, why corporate governance? It talks about that we have to follow the law of the land. Is that we have to follow the law of the land. Clearly articulate division of responsibilities. See, this is why we say we are talking in terms of all through the time. We say that see this is the basic rule. You remember this. In audit, no two people should perform the same job. One person should not perform two jobs. That is wherever you find it, and you will find this in the examination questions. Examine not once, at least 3 or 4 places you will come across this type of questions in different situations. You have to make sure that there should be a division of responsibilities among whom supervisory, regulatory and enforcement authorities. Within the organization, is right? Usually people who are supervising, people compliance, if you take into consideration what will happen, every company will have a compliance department. Every company will have an internal audit department. Is that every company? It means you should have a different, the compliance should be different, the internal auditor should be different, the supervisory people to be. The moment you will have the things, what will happen? They will cross verify the functions done by the other party. Is that this is the principle 1. The principle 2 says that should protect and facilitate the exercise of whom shareholders' right. The shareholders should be heard. Is it that the shareholders' voice should be heard by the management? You cannot say that yes, he is having only 100 equity shares. He is not important. That is not the case. That is the reason we are talking in terms of voting rights. Voting rights is based on number of shares you are holding. Is that voting rights? Means you have to protect. Most importantly, I told you this. You have to protect the shareholders' rights. You cannot say that yes, I am a dominant, I am having 30% shares. I can take decisions as much as possible. That's not the case. Always, all the shareholders have the equal opportunity. That is the principle number 2. Third is the corporate should ensure that there should be an equal treatment. Equal treatment of all shareholders, including minority and foreign shareholders. I told you, a person is investing, is it right? A person is investing in Tesla shares. We are here, and it's happened. We are here. We are investing in US markets. But what will happen? We should not think that yes, people are there who will think that yes, only yes, we are getting yearly dividends. Our value of the share is increasing. But we are investing means we have our voice to express. That is the reason whenever there is a AGM, annual general meeting, every shareholders have the option to ask questions. Everyone will have the equal right. Nobody, they will not see whether the moment you have the right to attend AGM. In the AGM, irrespective of your number of shares, Whether you are minority or you are foreign investor or the majority, you have the all shareholders have the opportunity to effective redress for violation of their rights. Means, in simple words, a shareholder should not get suppressed. Is it? All shareholders shall obtain effective redress. While if something goes wrong against the share, that is the reason. Corporate governance says that all are equal. Corporate governance says that if you have to give, protect the shareholders' right. Otherwise, what will happen? Few people will manage. Is it that most of the time? What will happen? Directors. We have said directors are agents. Directors are the agents of shareholders. Is it right? Directors are the agents of shareholders. What will happen? Directors will have a different view, shareholders will have a different view. The company cannot prosper. Corporate governance rule says this. It also says that says again, this is the entire summary of the things. It should recognize you recognize the rights of the stakeholder. First, they say shareholders. Second, they say stakeholders. With respect to law, who are the stakeholders? Employees are the stakeholders. Lenders are the stakeholders. Government is the stakeholder. Public is the stakeholder. People will not say, but in reality, these are the people. We are talking nowadays, we are talking so much of environment. Is it right? So much on environment. Every company will say environment. Every company will say ethics. Every company will say health, safety. Is it? Every company is talking about this thing. You have to rights of the established by law through mutual agreements, and we have to have a active cooperation between corporations in the firm and the stakeholders. See, then only things will go forward. Understand the point? Then only we are law-abiding company, law-abiding firm. We law-abiding. We have to take about. See, now people are talking about pollution. People are talking about environment. People are talking about energy. Is that people? These are the things. You have to conserve energy. You have to protect the environment. Is that you have to have every company will have HSE, health, safety, and environment. Every company now that is the basic things that we have to do. Means you are talking. If these things have been provided, what will happen? Automatically the wealth will be created. Otherwise, if you are exploiting, if you are going against the rules and regulations, it will not be beneficial. Is that it will not be beneficial. That means you have to make sure that the purpose is to have an environment where we are creating wealth, where we are creating jobs, and where we are having sustainable finance. Sustainable means you should have enough money we have to plan. Is it right? Financial planning should be there. Is it right? Financial planning for future which should be there. These are things what they are saying. If you come to a conclusion, we have to create wealth for the shareholders, we have to create jobs in the economy, and we should have a sustainable. If you don't have sustainability in finance, definitely what will happen? There is a possibility of bankruptcy. There is a possibility of bankruptcy. That is the principle 5. Yeah? What principle 4 says? Create the wealth, create the jobs, create a good financial position among. You should not have any financial distress. 5. Is it okay about this? Are you understanding what's happening?
Yeah.
Yeah. The corporate governance should ensure that there should be a timely and accurate disclosure. Disclosure has to be there, okay? We have to disclose notes to the accounts. Is it? We have to notes to the accounts. All material matters. All material matters in terms of value regarding corporation, including first financial position, talking about performance, ownership, and most importantly, governance. Is it? We are talking about what we have to disclose. We have to disclose what is the financial situation. Is that what is the financial situation? Means we should not, very simply, the company should not manipulate. Is that in some cases happens. Is that if you take into consideration, take 2018, 2019, 2020, 21, 22. We are not now in 23. Okay, what happens? It's going good. Is it? It has been decreased. It got impacted very, very heavily. Slowly and steadily, it is again coming back on a normal mode, but very slowly. During these years, most of the companies say, yes, we didn't have the ability to work it out in a very positive. We are incurring losses, but no one, I can say that no one company has manipulated. No one company has done window dressing. Is it? We are saying but nobody has done. We are giving reasons. Is it right? We are giving reasons why it has been went down. Is it? It happens with respect to the entire markets. Is it? That's why I say you have to, in every case, you have to give a financial position, you have to mention about the performance, you have to mention about the ownership structure. Is that who are owning ownership? See, if you see the annual report, okay? If you see the annual report, in the annual report they will mention who are the people who owns more than 10% of shares. Who are the people who are having 5% of shares? If it is a very broader category, they'll say that who are the people who are having more than 3% of shares. It is the fairness, it is the transparency, it is a disclosure. We are disclosing the ownership structure. We are disclosing the board of directors. Governance is nothing but we are disclosing the board of directors, composition of board of directors. Keep it in mind. We will say that the entire one, if you are talking about the one message, we say that we have to be very transparent. Is that we have to be very transparent, and we have to ensure that it has been timely and it has been accurately. Timely disclosure. We should not say that today happened, I will disclose after 1 week. No. Today happened, immediately you have to see. When we are talking about the timely disclosure, I told you in the previous sessions, is that you have to disclose to whom? You have to disclose to the stock exchange, regulator. Is that you have to disclose to whom? You have to disclose to the regulator. You cannot disclose on your own website. A firm cannot disclose on your own. You have to disclose to the regulator, stock exchange. They will display on their website. That is the proper way of disclosure. The corporate governance framework ensures that the strategic guidance, long-term guidance of the company, monitoring of management by the board, and there is a accountability to the company, and more important to the shareholders. Is it more important to the shareholder? This is what we say. This is strategic guidance. Board of here, what we are doing, we are talking in terms of what we are talking about the management of the board, role of the board. That's very important. Yeah? The effective monitoring of management by the board, and they say it is board's accountability. Board see, responsible is different, accountable is different. Accountability means you should answer, you should respond. Yes, this is what happening. We are answerable. Is it? We are answerable to the whom? We are board is answerable to the company and basically to the shareholders. Is it clear to you? Is it?
Yeah.
These are the six. These are the six principles. This gives you a complete understanding about corporate governance. Okay. Now we'll take these two slides and we will stop. Okay. We will take 7, 8 and 9. Okay. Right? Now you can have a very easy understanding. Nothing is difficult. Initially, you should understand how it is working. The global financial crisis prompted OECD to investigate in the shortcomings of global financial crisis happens in 2008. Is that global financial crisis happens in 2008? That has been prompted, is it right? OECD to invest. What happened? What are the reasons? If you have understanding about 2008, most of the companies become bankrupt. Most of the banks became bankrupt. Is that in 2010 they published a report, conclusions and emerging good practices. What are the best practices? Is it right? When they say it's a best practices, they identify 4 areas. What are the 5 areas? See, now governance of remuneration and incentives. How we are fixing the remuneration, especially we are fixing the remuneration of directors. They will ask questions that who is authorized to fix the remuneration of that director. Remuneration committee will be there. Is that remuneration committee will be there. You cannot fix, the directors cannot fix their own incentives. Is it? Improving the governance of risk management. Is that improve means what are the risks involved? Only to make sure that how important we can reduce fraud and errors. Risk management is also in terms of what? In terms of the financial aspects. Is that in terms of finance, in terms of borrowings, okay? In terms of borrowing, how much, at what rate you are borrowing, how you are negotiating, all the things will be there. It's a very broader area. And improving how the board practices, whether elections has been done, nominations has been done. There are so many rules are there. One of the rules that you can have director for 2 terms maximum, 2 re-elections. Okay, one first election, second re-election. That's all. After 2 terms, you cannot continue for the 3rd term. That is the best practice. Is it right? That is the best practice. A chairman will be there for 9 years. After that, a new chairman will come. Auditors will be there. Auditors will be reappointed. They say the same auditors will not be continued. Some best practices. They say that every 5 years we are changing the external auditors. It's a good practice. Is it? It's a good practice. That's what it says. Directors. Likewise, how we can improve the practice, and once we are doing this 1, 2, 3, 4, we are also concerned about shareholder. We are only making a point, exercise, and not only that, we are protecting. We are doing all these exercises only to make sure that we want to protect the shareholders. Is it okay?
Yeah.
Can we stop here?
Okay.
Okay.